They told you Islamic finance was outdated, irrelevant, a thing of the past. But what if I told you that behind closed doors, the world's most powerful Western banks are quietly borrowing principles from the very system they once ignored? What if the rules written centuries ago by scholars, merchants, and visionaries guided by faith are now shaping billion-dollar decisions on Wall Street and beyond? This isn't just a story of numbers. It's a story of stolen brilliance, of unspoken respect, of silent imitation. Stay with me, because by the end of this video, you won't just rethink what you know about money. You'll rethink what you know about power. In the complex architecture of global finance, interest, or riba, has long been the engine of most banking systems. It's seen as the heartbeat of lending. Borrow money, pay it back with more. But in quiet corners of boardrooms and behind sanitized corporate branding, some of the most powerful Western banks have begun to steer their ships in a different direction. They've started integrating riba-free models, not as a nod to Islamic finance, but as a response to economic crises, consumer distrust, and the rising demand for ethical banking. These models don't scream Sharia compliance on the surface, but look deeper, and the resemblance is undeniable. After the 2008 financial crisis, faith in interest-driven capitalism took a massive blow. Traditional loan systems crumbled under the weight of their own greed. People were losing homes, businesses were collapsing, and the global economy was bleeding. In response, certain institutions began to experiment. They explored systems where profits came not from interest, but from actual business performance and shared success. Instead of simply lending money and expecting repayment with added percentages, banks began to test out profit-sharing mechanisms where returns were tied to real results. That approach mirrors the Islamic concept of equity-based financing, where the lender and borrower share risk and reward. This shift wasn't shouted from rooftops, no press conference, no religious flag waving. It was strategic, careful, and calculated. The pressure was to draw a profit the same as it is with stocks, and then be where the branding was different. Words like risk partnerships, equity contracts, or performance-based returns were used, but under that corporate polish lay something familiar to any student of Islamic finance: the belief that money itself should not breed more money without value creation, that wealth should flow from trade, productivity, and mutual benefit, not from parasitic lending. Consumers notice too. Millennials and Gen Z, who dominate the next wave of financial users, have shown deep skepticism toward traditional interest-heavy models. They want systems that feel fair, that reflect shared human values. These banks, recognizing the shifting tide, adjusted course. What emerged were hybrid financial products, interest-free in spirit, halal in structure, but framed in the neutral, acceptable language of ethical or inclusive finance. And while they may never say it publicly, the roots of these systems are ancient. They come from the markets of Medina, the scholars of Baghdad, and the traders of Cairo. Echoes of a time when money served the people, not enslaved them. The core strength of Islamic finance lies in the principle of asset-backed transactions, where every financial deal must be rooted in real economic activity. This means that money cannot be traded for more money unless a tangible asset or service is involved, eliminating speculation and excessive risk. While this principle has been central to Islamic financial systems for over 1,000 years, it has quietly made its way into the foundations of several Western banking models, especially those that emerged in the wake of the 2008 financial meltdown. Asset-backed securities, once the villains of the crisis due to irresponsible packaging, are being restructured with a deeper focus on transparency and tangible value, mirroring Islamic finance more than ever before. In this environment, Western banks began to realize that building trust in an age of financial skepticism required more than just digital apps and marketing slogans. It demanded a system where customers could see and touch the value behind their money. Islamic finance, which has always mandated that every contract be supported by a physical asset, offered a framework that was both time-tested and deeply ethical. Major institutions began studying models where housing finance, infrastructure investment, and trade finance were all tied directly to physical assets. This shift was less about faith and more about risk control. If a loan is secured by an actual asset, the chances of catastrophic loss are minimized and customer confidence is restored. In their drive to innovate while reducing exposure to toxic speculation, some Western banks adopted sukuk-like instruments, Islamic bonds backed by real assets, as a tool to finance large-scale projects. These were issued not only in Muslim-majority regions, but increasingly in Western financial hubs, drawing billions in ethical investment. The label was secular, but the roots unmistakable. In place of interest, returns were structured around lease agreements or shared profit from productive use of the underlying asset. This was not an accident or coincidence. It was silent recognition that the Islamic model had stability, where the Western system had chaos. As these structures gained traction, they opened the door for further borrowing of Islamic principles under the guise of risk-managed or sustainable finance. The markets didn't blink, investors responded positively, and the systems grew stronger. What the world was witnessing, without press releases or headlines, was the silent import of centuries-old Muslim financial wisdom into the heart of global capitalism. The foundation of Islamic finance rests upon the prohibition of interest, or riba, which is seen not only as morally unjust, but economically destabilizing. Instead of earning profit through interest, Islamic financial systems encourage earning through shared risk and real economic activity. In recent years, Western banks, particularly in their ethical and sustainability departments, have started quietly adopting interest-free mechanisms in selected products and markets. This shift is not branded as Islamic, but the principles are undeniably rooted in centuries-old Islamic teachings. Through instruments like equity-based financing, profit and loss sharing, and ethical microlending, these banks are experimenting with models where the institution only earns if the customer succeeds, flipping the traditional lender-borrower relationship. Microfinance institutions and community banks in the West, especially after observing the destructive effects of high-interest loans, have been seeking alternative methods that are sustainable and socially responsible. In many cases, they've landed on structures almost identical to Mudaraba or Musharaka, Islamic profit-sharing partnerships. These models allow banks to invest directly in ventures, sharing both profits and losses. It's a slower process than traditional lending, but one that fosters long-term relationships and reduces defaults. By removing the guaranteed return demanded by interest, banks are forced to assess the viability of the actual business venture, encouraging deeper due diligence and a focus on real value creation. This not only reduces risk, but aligns the interests of the bank and the entrepreneur more closely. Even in mainstream retail banking, products are emerging that avoid traditional compound interest. These include zero-interest credit lines with fixed fees or markups, which, while structured differently, echo the Islamic concept of murabaha, where a profit is made on the sale of a good rather than charging interest on a loan. These instruments are often packaged as ethical or transparent finance tools, avoiding religious terminology but mirroring the financial morality of Islamic law. Customers drawn to these products often do so for practical or ethical reasons, not realizing the underlying inspiration. While Western banking rhetoric continues to use secular terminology, the strategic shift away from interest-heavy products in specific areas reflects a deeper reckoning. Interest, once seen as the foundation of all finance, is being questioned in boardrooms, academic journals, and policy think tanks. Not necessarily because of religious influence, but because the cracks in the system exposed by economic crises revealed that interest-heavy models prioritize short-term profit over long-term stability. In turning to risk-sharing and equity-based models, Western banks are quietly acknowledging what Islamic scholars have emphasized for centuries. The global push toward ethical investing and sustainable finance has forced Western institutions to reevaluate the moral foundations of their economic systems. In this pursuit, many have discovered that the values long embedded in Islamic finance, such as transparency, fairness, and social responsibility, naturally align with modern expectations of ethical banking. Rather than reinventing the wheel, they are subtly integrating these time-tested principles, often rebranded under ESG, environmental, social, and governance, or impact investing labels. But at their core, many of these values reflect what Islamic finance has upheld for over a millennium: that money should serve society, not enslave it. One of the most critical shifts has been the rejection of exploitative practices that maximize profit at the expense of human dignity in Islamic finance. Any transaction that leads to injustice, ambiguity, or the exploitation of a weaker party is forbidden. This foundational ethic is finding resonance in modern Western financial circles, especially as public scrutiny of corporate behavior intensifies. Today, Western consumers demand transparency in how their money is invested. They want assurance that their funds aren't fueling arms trades or environmental destruction or labor exploitation. Islamic finance's historical ban on investments in alcohol, gambling, weapons, and other harmful sectors fits naturally into these new ethical boundaries. And so, without acknowledging the source, major banks are now screening investments in nearly the same way. Another principle gaining ground is the concept of financial inclusion. Islamic finance has always prioritized providing equitable access to capital, especially to underserved communities. In the West, this concept is being echoed in community banking and micro-lending initiatives designed to empower marginalized populations. These efforts are not labeled Islamic, but they replicate the spirit of inclusion that Islamic finance has long embraced. The idea that finance should lift people up, not trap them in cycles of debt, has moved from the fringes to mainstream policy discussions. Even the structure of accountability is shifting. In traditional Islamic finance, every financial move is meant to be traceable, clear, and accountable to both God and society. As Western institutions now face pressure to be more transparent with stakeholders, they are adopting rigorous reporting standards and ethical codes of conduct. These practices, though newly emphasized, have long been ingrained in Islamic jurisprudence and encouragement to be proactive and responsive. What was once dismissed as religious idealism is now being embraced as sound, future-facing economic logic. Western institutions, driven by necessity and public demand, are unknowingly walking paths laid down centuries ago by Muslim economists and jurists. The concept of risk sharing instead of risk shifting is a cornerstone of Islamic finance, and it's quietly being adopted by several Western financial institutions as they explore more resilient and equitable financial models. In traditional Western finance, the burden of risk often falls disproportionately on the borrower, whether it's in the form of interest-heavy loans, subprime lending, or exploitative credit card debt. The institution ensures its profit regardless of the borrower's success or failure. This structure led to the 2008 financial crisis, where banks profited while millions lost their homes and livelihoods. In contrast, Islamic finance promotes shared responsibility between lender and borrower. The idea is simple. If there is a profit, both parties share it. If there is a loss, both parties bear it. This balance promotes fairness and reduces the chance of systemic collapse. This philosophy is being reflected in the rise of venture capital and equity-based financing in the West. Venture capitalists don't offer loans. They invest capital and only succeed when the business does. This mirrors Islamic principles of mudarabah and musharaka, where partnerships are based on profit and loss sharing rather than fixed returns. In these models, the investor and the entrepreneur become partners in both risk and reward. Such approaches encourage genuine investment in sustainable business ventures rather than parasitic profit extraction. Another area where risk sharing is gaining traction is in the development of peer-to-peer lending platforms and decentralized finance, DeFi. These systems often bypass traditional banks and facilitate more balanced financial agreements. Some of these platforms are now experimenting with contracts that echo Islamic finance in spirit, where the terms emphasize mutual benefit, transparency, and ethical behavior. While they may not use the same terminology, the framework is uncannily similar. These innovations are not accidents. They are responses to the failures of risk-shifting models that dominate conventional finance. Additionally, regulators and economists are increasingly acknowledging that risk-sharing leads to more stable financial systems. Central banks and think tanks now publish papers advocating models where banks have skin in the game rather than offloading all liability onto borrowers. This shift is subtle but significant. Without explicitly crediting Islamic finance, Western financial leaders are incorporating its most essential principle that sustainable finance must be built on fairness, shared outcomes, and ethical intent. What they once overlooked is now being repackaged as the future of resilient global banking. The ethical framework in Islamic finance, often dismissed or misunderstood in Western circles, is now being reconsidered as a model of responsible banking. At its core, Islamic finance is not just about prohibiting interest. It's about building a system where transparency, social justice, and morality are embedded in every transaction. In recent years, as scandals rocked major Western financial institutions, fraudulent mortgage schemes, insider trading, unethical investment practices, the demand for a more principled approach to money management has grown. Customers and investors alike are pushing for accountability and alignment between profit-making and public good. This is where the ethical backbone of halal financial principles starts to stand out, not as a religious artifact, but as a universal value system that promotes integrity. Western banks, whether openly or covertly, are integrating these ethics into their operations. Some now screen their investments to exclude industries that harm society, like weapons manufacturing, gambling, or tobacco, mirroring the Sharia-based screening of prohibited sectors. Environmental, social, and governance (ESG) funds have emerged as a major trend, and the criteria closely align with Islamic financial ethics. It's no longer just about making the most money. It's about how that money is made and whether it uplifts or damages the broader community. The values driving halal investing, such as justice, trust, and accountability, are being echoed in the codes of conduct and mission statements of major Western financial players. Moreover, internal policies in these banks are now encouraging ethical lending, transparent contract terms, and avoiding exploitative practices. They're adopting frameworks that are designed to prevent asymmetrical advantages where one party dominates and the other suffers. These ideas were long held in Islamic finance under the concept of avoiding gharar, excessive uncertainty, and zulm, injustice. Western banks, even if unaware of these exact terms, are recognizing that long-term success lies not in extraction, but in mutual respect and benefit. What's most ironic is that the very principles Muslims have practiced for over a millennium, only to be mocked or sidelined, are now being championed as groundbreaking innovations in modern finance. The West is dressing these ideas in new vocabulary, giving them contemporary packaging, but the DNA remains Islamic at its root. These ethics aren't just spiritually resonant, they're strategically smart. And the world is slowly catching on to the fact that a financial system guided by ethics isn't just morally superior, it's economically more resilient. So now the truth stands in the open, not whispered, not hidden. The very financial principles rooted in Islamic tradition, once dismissed by the world as outdated or restrictive, are quietly being adopted by the most powerful banking institutions in the West. Halal ethics, risk sharing, and justice-based systems are no longer just part of history. They are being rebranded and repackaged as the future of ethical finance. Muslims must recognize the treasure that was always in their hands, the wisdom passed down for centuries, the system designed not to exploit, but to elevate. This isn't just a wake-up call. It's a reminder of who we are and what we're capable of when we lead with truth, integrity, and courage. Thank you for walking with me through this journey of hidden truths and powerful realizations. May you carry this knowledge with pride, share it with purpose, and use it to build something greater than yourself. Good luck, and remember, when we reclaim our legacy, the world has no choice but to follow.